Did you ever wonder if your trading results are because of your skill or just the market being nice to you? There's actually a metric that tells you exactly that. It's called the Jensen's alpha, and it shows you if you're really outperforming the market after accounting for risk. In this video, I'm breaking down the Jensen's alpha step by step, using easy examples, and by the end you'll be able to understand what the Jensen's alpha is, see how it's calculated, and know when to use it to measure your own or someone else's performance. So let's dive in. Jensen's alpha is a performance metric that measures how much return your portfolio earned compared to what it should have earned based on its level of market risk. In simple terms, if you took on a certain amount of risk, the market expects you to get a certain return. If you beat that return, your Jensen's alpha is positive, and it means you added value. And if you did not beat it, your Jensen's alpha is negative. The market did the heavy lifting, not you. The term Jensen's alpha comes from Michael Jensen, an American economist. He introduced the concept in 1968 while researching mutual fund managers. His goal was to separate skill from luck, and at the time many funds claimed to outperform the market, but Jensen then asked, are they really outperforming or just riding the market wave? So he created a formula that adjusts performance to market exposure. That way the only true skill shows up in the results. This is the actual formula for Jensen's alpha. It is the actual return minus the risk-free rate plus beta times the market return minus the risk-free rate. Let's simplify that. You are comparing what you actually earned versus what you should have earned based on market risk. Let's walk through this by using Bob and Alice again. Let's say that Bob runs a portfolio that returned 14% over the year. The market returned 10%, and the risk-free rate, like treasury bills, is 4%. Now Bob's portfolio has a beta of 1.2, meaning that it's riskier than the market. If we plug all these numbers into the formula, then we get an expected return of 11.2%. His actual return was 14%. So, if we calculate Jensen's alpha, we get 14% minus 11.2 is 2.8%. Bob outperformed what was expected from his risk level. His alpha is positive. But now take a look at Alice. Alice returned 9%. Her beta is 0.8, which is less risky than the market. Add these numbers to the formula, and Alice was expected to return 8.8%. But she returned 9%, not much higher, but still above. So in this case, her Jensen's alpha is 9 minus 8.8, which means 0.2%. Alice also added value, but just a bit. In other words, Bob took more risk, so his hurdle was higher. Alice was more conservative. And this is the key, Jensen's alpha adjusts for the riskiness of their portfolios. So why should you care about Jensen's alpha? Well, it helps you to spot true performance from market noise, and to evaluate fund managers, robo-advisors, crypto trading advisors, or even your own trading strategy. And it avoids being misled by high returns that come with high risk. Because a high return isn't always good if it came from reckless risk. So to recap, Jensen's alpha helps you figure out if you're actually outperforming the market, or just riding the wave. It adjusts for risk, so only real skill shows up. Now if this video helped you, then hit that like button. Drop a comment with a question or your own alpha example, and subscribe if you do not want to miss the next video in this series. Now become a patron if you want to support me and motivate me to make more videos in the future. And I have also written a book that contains more information about algo trading, and it contains a whole chapter on how to analyze your results and determine the best trading strategy for you. If you want to know more about other investment ratios and how to use them, then check the playlist and watch out for future videos in this series. Thanks for watching, and I'll see you in the next one. Goodbye!